Good evening, my friends, and welcome to the market wrap for Monday, January the 27th. This evening, I want to spend a little bit of time talking with you about risk management and the importance of actively managing risk, not being idle. I heard from a number of you today, and some of what I heard is unfortunate. And as the program grows, there's going to be a certain percentage of people who learn about risk management, well, the way that I learned about risk management, learning about it the hard way. Some people saw prices fall. Some people decided that they would allow prices to fall further in the hopes of a bounce back. Some people saw that what unfortunately that can do to a portfolio, especially if you're not position sized appropriately. And it really is one of the big reasons why we spend so much time focusing on this every single weekend. Many times I'll even hold up this piece of paper during the week and point out that this traffic light is a big part of what helps has helped me personally to be in this game for so long. Sure, you could write off the first 10 years of my trading journey because I was up, I was down, and I nearly threw in the towel. But after that first 10 years where I hadn't a clue, finally getting to about 2010, 2011, when I finally discovered who William O'Neill was, and I finally discovered the New York City IBD meetups, and then later on, studied with Van Tharp and Mark Minervini, Mike Webster, Charles Harris. So all these people that perhaps you may have heard of, perhaps you've at least heard of some of them. One of the big things that I learned from doing all that and why I've been in this game for so long has to do with risk management. And so much of risk management comes from putting the pieces together. So much of risk management is an understanding of what we call portfolio heat. Portfolio heat is the maximum amount that we stand to lose at any given point in time. When we look at the open positions that I have, I'll go over to the open trades tab, and right now I have 18.3% of capital still allocated to stocks. We'll go through the remaining names momentarily. And I now have 0.18% of capital at risk. And it's, I was thinking about what was said over the weekend where I believe I mentioned that, oh, if every stop is hit, then I would stand to lose roughly 2% of capital. Well, the market put that to the test, and that's basically what happened. All those stops hit, many of them, right? Let's actually go over to the closed trades tab, and I invite you to do this because I do play with an open hand, and the idea with what I'm doing and how I'm presenting it is so that way you're able to learn. That way you're able to go and learn how to do this kind of stuff on your own, and you're able to see why certain things are done in the way that they're done. But you take a look at these trades here, right? So TOST lost about 4% overall. We'll go through the details. MIR lost about 6%. TNA, break even 0%. Coin, COIN, lost 8%. Tesla lost 6.2%. And these are the ones that were all closed today. Now, with all those percentage losses, it sounds like a pretty rough day. And sure, yeah, you might look at a 2% capital drop in your equity curve as a lot. Maybe some of you, to me, that's within range and actually not that bad, especially considering that these stops were hit almost in their entirety. The only exception being, well, TNA and TOST. That one was exited early. Again, we'll talk about all the reasons why later. But the main point is that risk is being managed. Risk is being managed well in real time. And when we take a look at the bigger picture, how we manage risk, the more that we're able to keep losses small, even when it feels like, oh man, there's so much that's going against us. Let's just, you know, get rid of the stop loss. Who needs a stop loss? Maybe price will rally back. Maybe price will rally in my face. So let's get rid of the stop loss. And you know, I don't want to feel like a fool selling at the bottom and seeing it rally and hopefully price comes back. Well, this is the reason why I'd much rather have a 2% capital loss overall than something that could end up being far, far worse. So, and part of the reason why, or part of how I go about determining the amount of capital that I'm willing to put at risk and the amount of trades that I'm willing to put on, so much of it all comes down to what we're doing here every single day, defining the market's mood. So let's go through the general market portion of this, the major indexes. We'll go through the stocks and we'll go through the personal performance. So let's hop on into the charts. So here we have the S&P 500, the NASDAQ, the Russell 2000, the New York Stock Exchange, the Dow, and the IBD 50. And now you notice IBD 50 was down pretty big today. The IBD 50, a halfway decent representation of growth stocks in general, down almost 9% on the day. A lot of those in there, your big AI stocks, your big semiconductors, Nvidia down big, ARM down big, Palantir, App, all those names, many of them fell pretty hard. Take a look at the indexes. Well, the S&P 500, sure, it tested the 50-day moving average. It dropped about 1.5%. It actually touched the 50-day moving average and then closed at the top of its trading range. Interesting. Still counts as a distribution day, but interesting that it would hit the 50-day moving average and then bounce off of it. The NASDAQ closed underneath the 50-day moving average, closed in the middle of its range. Okay. The Russell 2000 started to rally in the morning, then it hit its head on the 50-day moving average, closed at its lows, closed right on the 10-day exponential moving average. All right. Here's the NYSE. The NYSE tested the 5 EMA, it reversed, it closed at the top of its range. The Dow actually closed up on the day. It pulled back towards the 10 EMA, reversed, closed at the top of its range, and had a positive outside reversal day. So what does all this, how can we interpret all this? The way that I interpret all this is that we've got a choppy market. If you recall from over the weekend, one of the things that we mentioned was that we were having this proverbial tug of war, and we cited some of the reasons why there was this proverbial tug of war, even with the market, S&P 500, NASDAQ, at highs and eyelash away from highs. There were underlying reasons for that. Some of the underlying reasons had to do with the number of 52-week highs versus 52-week lows. That ratio is one that's very important, and that ratio, quite frankly, isn't so great right now. It wasn't so great over the weekend. It's not so great now. On the NASDAQ, there were 50 stocks that made new 52-week highs today, 30 stocks made new 52-week lows. Not sensational, right? That's very non-committal. Same thing with the NYSE. Even though the NYSE price action wise is doing a little bit better than the NASDAQ right now, on the NYSE, you have 61 stocks making new highs, 10 stocks making new lows. Yeah, that's a little better, but it's not where it's blowing flames. Relatively non-committal as well. A little bit of hesitancy there. Interesting. I mentioned that the S&P 500 picked up a distribution day today. Has two distribution days in the last 10 days. We'll see what happens there. But the main thing, and it'll become even clearer when we take a look at the weekly and the monthly charts, and also take a look at the spreadsheet. You start to have more indexes moving in slightly different directions. It's not where it's too dramatic yet, but they're starting to move in different directions. The monthlies are still basically the same, even though you had this kind of crazy sell off, at least in some stocks. Take a look at the monthlies. The monthlies actually are not that bad. And it's one of the things that's leading to this slow grind higher. And when you do have a slow grind higher, it becomes very tempting to start to break some rules, start to let your plans fly out the window. Well, if we're in the slow grinding market higher and my stock happens to gap down on me, maybe I should hang on. Sounds like a good idea at the time. Unfortunately, it tends to be later on that we find out why it's not always the best idea. And if we are caught in that situation, if we do find ourselves caught in that situation, often the best thing to do is to let the trade go, give ourselves some space to recover mentally, emotionally, give ourselves a little bit of breathing room, and then go back and do a post-mortem of, well, what happened and why did it happen? Try to take away the lessons from it and try to be in a neutral state. If we try to learn in a negatively charged state, the lessons tend to not be the lessons that we want to take away, and they tend to be not quite as positive or productive as they could be. So I would encourage you to, if you are finding yourself in such a place, to take a breather, give yourself a little bit of time, then go back, do that post analysis, and extract the lessons that you can while you're in a neutral mental state. So let's take a look at the spreadsheet, because I think the spreadsheet is also very telling of the kind of market environment that we're in. You take a look at the market mood log. I'll click on the market mood log. It's right over here. And you take a look at this. Every time that the trend changes direction, I use a different color other than black. So we've got a trend change on the NYSE, on the NASDAQ, on the S&P 500, all in the daily time frame. Then you have trend changes on the NYSE, the Russell 2000, the NASDAQ, and the S&P 500 on the weekly. Monthly is still the same. But you go back over to either of these and you see, well, you have some moving sideways, but negative, some moving sideways but positive. Some of them are in an uptrend. So now you've got this market environment where you're scattered, you're going in all different directions. Of course, it's going to lead to choppiness. Still in a yellow condition, though. Why still a yellow condition? There are still some setups, depending on which stocks you might be in, are still acting positively. The market hasn't rolled over yet. The market is still hanging on. The market is still in places where it's holding support. If we scroll over a little bit and you take a look at the alerts and you take a look at the focus list and in the neighborhood and weekend setups, there's still plenty of merchandise. In order to appear on the action list, it has to be a trade where I'm personally comfortable putting my money to work in it if the conditions are right. Right now, there's two such names, even though, and coming into today, and we'll talk about this in a moment too. We did have a name trigger an alert earlier today, SFM. I opted not to take that one, and the reason why had to do with the market conditions. And it did break out on volume. It did close well. I still opted not to take it due to the market conditions. The number of stocks on the action list tell us something. It tells us that there's a certain level of quality. If you're trying to replicate this kind of process on your own, then that's one of the things that your action list and your focus list and your lists can really help you do. Assess quality. And that assessment of quality will give you a better feel of the environment that you're in. The setups, as of today from the weekend, only 20% of them are positive so far on the week. That should come as no surprise given the kind of action that we saw today. Many of them are down significantly. Some of them down double digits. Some of them down pretty heavily. Let's talk about one of them. One of them that I saw on this list here that was on the in the neighborhood list. It's not there anymore. It was also an open trade is MIR. So let's take a look at MIR. Here's MIR. MIR started the day gapping down. It gapped below the 50-day moving average. Thankfully, it opened pretty close to the stop loss. My stop was actually filled at $16.78. The stop was set at $16.90. I decided to keep that stop loss on. In fact, I decided to keep all my stop losses on and active. And part of the reason why is because there were so many stocks gapping down, I was not even in a position to be able to micromanage so many different names. So let whichever ones are going to hit their stops. Trust that I've done my job and set them at appropriate levels. And then, if and only if they recover, then attempt to get back into them. Well, MIR dropped down, it gapped down below the 50-day moving average, ended up taking about a 5.5% loss on it between where I entered and the stop. Price kept on falling and falling and falling and ended up being down 19% of the day. So it was actually a lot better to take the loss earlier than later. They say that the only way to prevent a large loss is by taking a small loss. This is a prime example. Let's take a look at TOST. Now, this is one that I decided to exit based on danger signals. This says 5. I'd argue that that there could be a sixth one in there, with price closing below the 50-day moving average, closing below the 5-day exponential moving average, the 5-day exponential moving average starting to roll over. I'd also make a case, even though it technically is not below the last 3 days of lows. If we look at it based on candlesticks, it's below the body of the last 3 bodies of candles. Just one of those little subtler nuances that, you know, I might not even have thought to look at, because it's one of those things where if you do it thousands and thousands of times, you just have this feel. But that one didn't seem right to me. And so I decided to sell it at the close. And so this one ended up being uh, a about a 4% loss on TOST. Keep the losses small. Then Tesla. Didn't think that I would be selling Tesla here, but I did. Tesla fell. It fell below the stop loss. I had my stop set at 393.90. It was sitting right around the 50-day moving average. And Tesla is one of those names where I do like the company. I do like many things about it. I'm admittedly a fan of Elon. And so I could sit here and try to make up excuses for it. But if I turn off all the annotations, if I turn off the danger signals, if I blocked out the name right here, I just saw the chart. And I asked myself, self, would you buy this stock right now? I take a look at it and say, oh, well, you know what? It is on the 50-day moving average. Maybe it's bouncing, but earnings is 2 days away. You do have the short-term moving averages right in your face right now. All of them are rolling over. You also have the stochastics rolling over. At best, I would call it a C-level trade. Right? There's some major flaws baked in there right now with all those things. Maybe, yeah, no, maybe like C plus B minus at best. And maybe even that's being a little bit too generous. So that helped me make the decision to not only get out, but to also stay out. Then we've got TNA. TNA pulled back. It hit my break-even point at $44.12. At the end of the day, it rallied slightly, but the same thing here. Would I want to enter this trade without knowing anything else? The answer is no. So that's something else. Risk management, stay out. Here's Coin. Coin 2 gapped down, started to recover a little bit intraday, and then it fell apart. It hit the stop loss at 272.90, recovered some, still closed below the 21 EMA, still closed below everything else here. 8 danger signals on the day. It would be an exit for me regardless. So I decided to sell and to stay out of the trade as well. So exited 5 trades. 4 of them at small losses, 1 of them at break even. The 2 that I'm continuing to hold are on, which it too started the day down. It rallied, it closed at the top of its trading range. At this point, the 21-day exponential moving average, that purple line right there, is caught up to my stop loss. And so therefore I'm going to keep my stop loss at $57.40. Very similar to RBRK. Now that this price action is not as good as what On had. This is also, I would consider this to be a negative outside reversal day. It pushed higher. It closed in the lower half of its range. It came within 10 cents of hitting my backstop. It held the 21-day exponential moving average. So for right now, I'm just going to leave my stop loss at $67.30 on this one. For tomorrow, I still have two stocks on the action list. Both of them, I'm keeping the same alerts as we had coming into today. With EHTH, I'm keeping the alert set at $10.70. And for Netflix, I'm keeping the alert set at $1,001.10. On the weekly charts, both of them still look sensational. Netflix setting up in a potential short stroke pattern. EHTH setting up in a potential high tight flag. We'll see how either of these names do. For right now, personally, I'm going to be trading small, smaller than I have been on some recent trades. Even though the general market, I would say, general market, even the system, I would say from a system perspective, it's yellow to red. I would lean a little bit more towards red condition, which means that on new trades, I would be looking to take about 6.5% capital allocation, no more than 0.5% capital risk on new trades. And I would keep that until I begin to gain traction. On my most recent trades, I have not gained any traction at all. So I'd want to start to build up some winners, start to build back a little bit of capital, little by little by little. And then that's how you make it back. My good friend Mark Minervini said that we want to be trading our biggest when we're trading our best, and our smallest when we're trading our worst. I used to think that meant something personal about me. Like, am I playing the best? I think that there's truth in that. I also think that there's truth in a mechanical system-based approach too, where I look at myself a little bit more as the referee than the trader. Is this trade behaving the way that it's supposed to? And if it is, then let it continue to work. If it's not, then gets pulled. Well, in this case, there's not too many trades that are entering the arena doing well and performing. So I want to give them a little bit of time to start to work. When they do begin to work, that's when there'll be more profits to begin putting on more sides. Until that happens, then I'm going to be trading small. And it's in that trading small that, again, as I mentioned earlier, I've been trading well now for, what is it, about 15 years. A lot of it has to do with this. A lot of it has to do with the position sizing. A lot of it has to do with learning when to scale up, when to scale down. If the performance isn't there, it's time to scale down. It's a little counterintuitive. And the reason why is because if you do have a loss, you want to make that loss back very quickly. As they say, if you're in a hole, if you want to get out of the hole, the first thing that you got to do is put down the shovel. So if that's you, that's part of my advice. Anyhow, that is it for this evening. We spoke about a lot of things in today's market wrap. If you have any questions at all, if you need some help, please feel free to reach out to me. I'm here and I'm willing to help you guys. So that's it for me. Till tomorrow, take care, much love, and as always, God bless.